Silver just printed a number that should not exist in a controlled market. $120, not on headlines, not on CNBC, not trending on social media. But inside the physical market, that number just flashed, and it changes everything. If you are only watching the paper price, you are already late. The real market just broke away, and almost nobody is talking about it yet, which is exactly how the largest moves begin. Here is the part that should make you sit up straight. The paper price is still pretending nothing happened. COMEX futures are calm, ETFs are quiet, analysts are recycling the same tired narratives. But physical silver premiums just exploded in places that matter most. Industrial buyers paid triple-digit prices to secure immediate delivery, not futures, not promises. Metal in hand. When physical trades at a massive premium to paper, it is not noise. It is a warning signal, and historically, those signals only show up right before the price loses control. This is not retail panic buying coins. That story is old and misleading. This is wholesale metal moving between vaults, refiners, and end users, solar manufacturers, defense contractors, electronic suppliers, entities that do not speculate and do not chase momentum. They buy only when supply becomes uncertain. And right now, supply certainty is gone. That is why the physical market is screaming while the paper market is whispering, and that divergence is where the real story starts. Look at inventories, not opinions. Registered silver on major exchanges has been draining steadily, but the pace recently changed. Daily outflows accelerated, while deliveries failed to replenish stock. In previous cycles, inventories fell gradually. This time, they are dropping while demand is rising, which rarely happens together. The combination creates price pressure that derivatives cannot suppress forever. The system can manage one stress point. It cannot manage all of them at once. The reason this matters is mechanical, not emotional. The paper silver market is built on leverage. For every ounce of physical silver available, there are dozens of paper claims. Under normal conditions, that works because most participants settle in cash. But when physical demand spikes and buyers insist on delivery, the math stops working. Someone must source real metal. When they cannot, premiums explode first. Price follows later. That is exactly what is happening now. Here is what insiders watch. They do not watch the headline spot price. They watch spreads, they watch delivery delays, they watch how far futures contracts trade below physical quotes in Asia and the Middle East. That gap recently widened to levels last seen during extreme stress events. When arbitrage desks cannot close that gap because metal is unavailable, the price discovery mechanism breaks. That is not a theory. It has happened before, and every time it did, silver repriced violently. China is a key part of this story, and it is being ignored on purpose. Chinese physical premiums quietly surged while Western markets stayed flat. That tells you metal is being pulled east, not sold. When China pays more for immediate delivery than the U.S. futures market implies, arbitrage should flow metal west to east until prices equalize. But that is not happening at scale. Why? Because there is not enough excess silver available to move. The system is tight, and tight systems snap. At the same time, industrial demand is not slowing. Solar installations continue to grow, and each panel requires silver that cannot be substituted easily. Electric vehicles use more silver than internal combustion engines. Grid infrastructure upgrades consume silver at scale. None of this demand is optional. None of it disappears when prices rise. In past cycles, high prices kill demand. This time, demand is structural. That is a crucial difference, and it changes the upside-down math completely. Banks understand this risk, which is why their positioning looks strange if you know how to read it. On the surface, they appear calm. Underneath, their hedging activity tells a different story. Short exposure is being rolled, not expanded. Duration is shrinking. That means they are not confident they can suppress prices indefinitely. Banks do not panic publicly. They reposition quietly. That is what happens right before volatility breaks out. The $300 target being whispered is not a fantasy number pulled from thin air. It comes from simple ratio math and past dislocations. When silver last disconnected from paper control, it moved multiples faster than gold. Today, the gold to silver ratio is still historically stretched. If that ratio normalizes even halfway during a physical squeeze, silver prices do not need speculation to reach triple digits. They get there mechanically. That is what makes this dangerous for anyone positioned on the wrong side. This is why almost nobody is talking about it yet. The media waits for confirmation. Analysts wait for models to update. By the time they acknowledge the move, it is already halfway done. The real signal always appears first, where the cameras are not pointed. Vault flows, delivery premiums, industrial scramble. And those signals are flashing now, and they are flashing hard. If this imbalance continues, the next phase is unavoidable. Futures contracts will begin to price delivery risk. That shows up as backwardation. When near-term contracts trade above long-dated ones, it signals immediate scarcity. Silver rarely stays in backwardation for long. When it does, Price moves fast because the system is trying to pull metal forward in time. That pressure is building, and once it releases, it does not give polite pullbacks. The most dangerous part for skeptics is that this does not require mass participation. It does not require retail mania. It only requires a small percentage of paper holders to ask for metal instead of cash. Even a modest shift overwhelms available inventory. That asymmetry is why silver moves look explosive. The market is thin, the leverage is high, the exit doors are narrow. Anyone monitoring this closely would notice something else that is easy to miss. Lease rates are tightening. When it becomes more expensive to borrow silver short term, it means lenders are reluctant to part with the metal. That is a classic precursor to supply stress. You see it before the price. You see it before headlines. It is the quiet signal professionals respect most. We are now at the stage where denial is still possible, but resolution is approaching. Either physical supply magically appears, or price adjusts upward to ration demand. There is no third option. Governments cannot print silver. Banks cannot create atoms. When reality asserts itself, it does so suddenly. That is why the move feels shocking when it happens, even though all the signals were visible beforehand. The reason this matters right now is timing. These conditions do not last long. Markets either normalize quickly or break violently. The longer the divergence persists, the more aggressive the eventual repricing becomes. That is the pressure building under the surface, and it is why insiders are watching silver more closely than at any point in years. And here is the cliff edge. Once price discovery shifts from paper to physical, control does not come back easily. The market chooses a new level and then builds a new range around it. That transition is chaotic, fast, and unforgiving. The early phase is always dismissed. The late phase is always obvious. We are still early, but not for long. Because the next thing that happens is the one nobody expects. And once it starts, there's no clean way to stop it. The next phase always begins quietly, and that is what makes it dangerous. Price does not explode first. Behavior changes first. Settlement behavior, delivery behavior, inventory behavior. Right now, those shifts are already visible if you know where to look. More contracts are being closed early. More counterparties are opting for physical settlement clauses. More delivery notices are being delayed or rerouted. These are not random glitches. They are signs of a system under stress that is trying to buy time. COMEX was designed to manage price discovery through liquidity, not scarcity. It works when metal is abundant, the claims are trusted. It fails when trust erodes. Recently, the ratio between open interest and registered silver reached levels that historically preceded sharp repricing events. That ratio means many more promises exist than deliverable ounces. As long as confidence holds, nothing happens. When confidence cracks, everything happens at once. This is where arbitrage normally steps in. Traders buy cheap paper silver and sell expensive physical silver, capturing the spread and bringing markets back into balance. But arbitrage only works if metal can actually move. When refiners are backlogged, when vaults are emptying, when shipping delays stretch from days to weeks, arbitrage collapses. The spread stays wide. That is exactly what we are seeing now, and it is why $120 physical prints are possible, even while futures prices lag far behind. This divergence exposes the illusion at the core of the paper market. Futures prices do not represent silver itself. They represent confidence in future delivery. When that confidence weakens, futures stop being a reliable signal. Physical buyers know this. That is why they stop negotiating price and start negotiating availability. Once that mindset spreads, price becomes secondary. Securing metal becomes the priority, and that shift accelerates scarcity. Banks are trapped inside this structure. They act as market makers, liquidity providers, and counterparties. They cannot simply step away. Their risk is not directional price exposure. Their risk is delivery failure. That is why they attempt to cap volatility through paper selling while simultaneously reducing physical exposure. This balancing act works until it doesn't. And when physical demand overwhelms hedging capacity, banks lose control of the narrative. The reason a $300 target enters the conversation here is not hype. It is stress math. When supply is fixed and demand is inelastic, the price must move to clear the market. Silver supply cannot respond quickly. New mines take years. Recycling adds marginal volume at best. Industrial demand does not pause. Investment demand is only just waking up. That imbalance means the price must overshoot to restore equilibrium. Overshoots are not smooth. They are violent. History does not repeat exactly, but it rhymes in structure. In previous silver dislocations, the market spent months ignoring warning signs, then repriced in weeks. The moves always felt irrational in hindsight, but they were mechanically justified. Today's setup is more fragile because industrial demand is higher, inventories are lower, and leverage is greater. That combination increases the amplitude of any move that escapes control. Another signal insiders track is ETF behavior, not flows, but inventory sourcing. When ETFs are forced to source metal at higher costs or from unusual locations, it indicates stress beneath the surface. Recently, ETF inventory changes failed to match reported demand patterns. That mismatch suggests metal is being leased, swapped, or otherwise temporarily sourced to maintain appearances. Those tactics work briefly. They do not solve shortages. They defer them. Meanwhile, premiums at the retail level are rising again, but that is not the story. Retail always reacts late. The story is wholesale bars trading at escalating premiums with longer settlement times. That tells you the bottleneck is upstream. Once upstream supply tightens, downstream pricing has no choice but to follow. That is why the physical market leads in paper chases. There is also a geopolitical layer that amplifies this setup. Strategic stockpiling is back, even if it is not officially acknowledged. Countries prioritize resources critical to energy, defense, and technology. Silver sits at the intersection of all three. When sovereign buyers enter quietly, they do not announce targets. They buy until supply resists them. That resistance is now visible. As this continues, futures markets face a dilemma. Either prices rise to discourage delivery demand or delivery risk escalates. Historically, exchanges choose price. They always do. The moment futures begin to reflect physical stress, algorithms amplify the move. Momentum strategies trigger. Volatility expands. What looked impossible days earlier suddenly looks conservative. This is where late observers get trapped. They wait for confirmation, they wait for headlines, they wait for analysts to upgrade forecasts. But by then, the easy part of the move is over. Silver does not trend smoothly. It gaps, it spikes, it retraces violently. That behavior shakes out weak hands and rewards those positioned before the chaos, not during it. The most important thing to understand is that nothing dramatic needs to happen to trigger the next leg. No crisis, no announcement, no catalyst, just continuation, just steady pressure on a system already stretched thin. Markets rarely break because of a single event. They break because accumulated stress finally exceeds tolerance. Right now, tolerance is being tested daily. Each physical drawdown matters. Each delayed delivery matters. Each widening premium matters. These are the grains of sand piling onto a scale that eventually tips. When it does, narratives scramble to catch up. But price does not wait for explanations. And here is the part almost nobody is prepared for. Once silver clears certain psychological levels, behavior changes across markets. Gold follows. Mining equities reprice. Currency hedging activity shifts. Silver is small, but it is influential. Its moves ripple outward faster than expected. That is why it is feared by institutions and dismissed publicly until it is too late. We are approaching the moment where suppression costs more than release. When that calculation flips, restraint disappears, price is allowed to run because containment becomes riskier than volatility. That is the inflection point insiders watch for, and it is closer than most people realize. Because once that switch flips, the move does not ask for permission. The final phase always feels sudden, even though it is built slowly. One day the market looks manageable, the next day the bids disappear. Offers gap higher, liquidity thins. This is not because everyone suddenly agrees silver is valuable. It is because the system reaches a point where price must do the work that supply cannot. That is the transition we are approaching now. When silver begins to move freely, the first reaction is disbelief. Analysts call it a squeeze. Commentators call it speculation. Banks call it disorderly. But none of those labels change the underlying mechanism. Physical demand overwhelms deliverable supply, and price is forced upward to ration buyers. The higher the price goes, the more paper shorts feel pressure, margin requirements rise, risk desks intervene, forced covering begins. That feedback loop is what turns a controlled market into an accelerating one. This is why the $300 discussion matters psychologically. Not because it is guaranteed, but because once triple digits are breached decisively, the old mental anchors break. Silver is no longer treated as a slow-moving industrial metal. It becomes a volatile asset again. That shift attracts capital that previously ignored it. Momentum funds, trend followers, macro traders, they do not need conviction. They only need confirmation, and price provides it. At that point, the paper market is no longer leading. It is reacting. Physical premiums dictate futures pricing, not the other way around. Exchanges adjust rules quietly. Position limits change. Settlement terms evolve. These actions are framed as stability measures, but they reveal stress. Markets do not change rules when everything is fine. They change the rules when control is slipping. Another overlooked factor is producer behavior. When prices rise rapidly, miners do not immediately increase supply. In fact, they often hedge less. They wait. They protect upside. That delays the new supply even further. Meanwhile, refining capacity remains constrained. Smelters cannot expand overnight. Bottlenecks persist. High prices do not solve short-term scarcity. They expose it. This is why silver moves overshoot fundamentals. The market does not glide into balance. It swings past it. Only after demand destruction finally appears does the price stabilize. But demand destruction in silver requires extreme prices because so much usage is embedded in critical systems. Panels must be built. Circuits must be completed. Defense contracts must be fulfilled. Silver is not optional at scale. As this unfolds, narratives flip quickly. The same voices dismissing the move begin chasing explanations. Charts are redrawn, targets are revised. What was called impossible becomes inevitable in hindsight. That is the nature of nonlinear markets. They punish linear thinking. The danger for observers is thinking there will be time to react. Silver does not ring a bell. It gaps on illiquid sessions. It moves overnight. It reprices when few are watching. By the time headlines catch up, volatility is already elevated. Risk-reward shifts dramatically in days, not months. From an analytical standpoint, the clearest signal to watch is not the price itself, but the behavior around pullbacks. In healthy, controlled markets, rallies fade easily. In stressed markets, pullbacks are shallow and aggressively bought. That behavior indicates urgency. It indicates participants fear being left without exposure. Early signs of that behavior are already appearing beneath the surface. Another signal is correlation breakdown. When silver begins to move independently of broader risk assets, it signals a supply-driven move rather than a macro one. That decoupling is rare, and when it happens, it commands attention. Recent trading shows early signs of that separation forming. The final acceleration phase usually surprises even seasoned participants. It feels unjustified. It feels uncomfortable. That discomfort is the signal. Markets do not reward comfort. They reward preparation. When the preparation phase is quiet, the payoff phase is loud. What makes this setup especially dangerous for the unprepared is leverage. The silver market is small relative to global capital flows. It does not take much to overwhelm it. When capital rotates, even modestly, price impact is outsized. That asymmetry is why silver remains one of the most volatile major commodities when conditions align. At this stage, the system is balancing on confidence. Confidence in settlement, confidence in availability, confidence in structure. Once that confidence erodes, the price must compensate, and the price does not negotiate gently. It moves until confidence is restored, which usually requires levels that seem extreme beforehand. That is the reason insiders are watching silver now, not later. Not because they expect a straight line up, but because they understand how quickly control can be lost once physical stress reaches critical mass. This is not a forecast. It is an observation of pressure. If you're watching this unfold in real time, the key question is not whether silver is volatile. It always is. The question is whether this volatility is being driven by speculation or by scarcity. Right now, the evidence points towards scarcity, and scarcity-driven moves do not resolve quietly. As this continues, more people will start asking how this was missed. The answer will be simple. The signals were there, but they were not where most people were looking. They never are. That is why conversations around silver are about to get louder, faster, more emotional. And by the time they do, the market will already be somewhere else. If you are seeing this now, you are seeing it early. And early is the only place where clarity exists in markets like this. If this breakdown of the silver market structure makes sense to you, say so in the comments. If you think this move is being underestimated, share this with someone who still believes the paper price tells the full story. Because once the physical market takes over completely, explanations won't matter anymore. And at that point, the price will speak for itself.